Hello, this is Brian Rezny, president of Rezny Wealth Management, of course, host of the Rezny Wealth Report. We've got a great show for you today. We're taking a lot of questions. Again, if you have a question about your portfolio, if you have any concerns about the advice you're receiving, send them to Brian Rezny at ReznyWealth.com. This show is all about you. Remember that. So if you have any concerns, any questions about investments, about your retirement, please send us your questions. We love to get you the right information so you, the listener, can make better informed decisions. You know, I want to talk just a little bit about the economy. U.S. economy is doing fairly decent. We got a slow growth economy. I firmly believe that as the year progresses, hopefully corporate earnings will continue to increase. Consumers are doing quite well. But with that said, we are seeing a lot of negative headlines that often come out. These negative headlines often cause investors to make bad decisions. Negative headlines sell media, but they often are not good decision makers for you. So make sure that you have an investment strategy. Your investment strategy includes risk management, and make sure the firm that you entrust your money to, your life savings, your retirement, is a fee-only fiduciary money manager. Remember, if you're working with Wall Street, a bank, or an insurance company, these firms are not fee-only fiduciaries. So are you working under Suitability and being sold investments, or are you working with a real firm that legally works for you? Make sure you understand that, and we're going to talk a little bit about that today. Don't be sold by Wall Street or annuity salespeople. I get this all the time from my TV and radio show. People will call me very disgruntled. They'll say, Brian, I'm working with XYZ big Wall Street firm. You're telling me they don't legally work in my legal best interest as a fee-only fiduciary? And my answer is, no, they do not. There is no bank, no insurance company, and no Wall Street firm that is a fee-only fiduciary. None of them. So you have to make sure, how are you doing business with this Wall Street firm? Is it under Suitability, where they legally don't work for you? They actually sell you investments that they manufacture or are required to sell. Find out the facts. Don't take it for granted. Too many investors, and I see this, I've been managing money for close to 30 years. I see this all the time. People will say to me, Brian, but the guy was a nice guy. I thought because it's a big firm, they were actually watching out for me. Not the case. Almost daily you hear about the fines and censures these firms get against their clients. Almost daily. Make sure you're getting real advice. Don't be sold. Annuities, one of the most oversold investments there are. These people have these free dinner seminars all the time with steaks. You, the unsuspecting investor, look out. Know what real advice is. You see that steak? That steak dinner is going to cost you way more than you ever thought. It could cost you your retirement and your life savings. Too many of these, what I call annuity salespeople or Wall Street firms, love doing these steak dinners. It draws retirees in all the time. You're looking for a free meal. Guess what, folks? That steak's going to give you some bad heartburn. Make sure you understand, anybody that has a free dinner seminar is probably trying to sell you an annuity that's ultimately going to steal your returns and basically gobble up your returns based upon the high, crazy expenses they have. There's no free money with annuities, and that steak is going to cost you dearly in your portfolio and your retirement. Suitability standard versus the fiduciary standard. I often will get this question now. I am one of the few people that do a live radio show that ever talks about suitability and fiduciary. In fact, I could probably guarantee less than 1% of my TV show listeners really understand the difference between suitability and fiduciary. Less than 1%. Let me explain. When you work with a bank, you work with an annuity salesperson, or you work with a Wall Street firm, generally speaking, you're probably working under what's called suitability, meaning these firms are really sales organizations selling you investments they are required to sell and they manufacture. Under suitability, a great example would be you want a turkey sandwich. You go to the local grocery store. You buy a moldy $3 loaf of bread. Suitability's been met because white bread works with turkey. It doesn't have to be wholesome, and it's clearly expensive. Fiduciary standard or a fiduciary firm like Rezny Wealth Management, we would have to use the wholesome loaf of bread off the bread truck that is much less expensive. $1.50 wholesome loaf of bread is much better for you than a $3 moldy loaf of bread under Suitability. Do you understand the difference? And again, don't believe that the firm you entrust your money with is working under a fee-only fiduciary status. In fact, statistically, less than 10% of firms nationally are fee-only fiduciary money management firms. That means 90% of the people out there are working with firms that are not fee-only fiduciary. Hello, moldy loaf of bread. Check out your advisor first. You're not going to hear this from Wall Street. You're not going to hear this from the annuity guy or the bank. Check out the firm before you entrust your money. Did you already hire a firm? Are you doubting what they're doing with your portfolio? Check them out. If you're working with any brokerage firm, you can go to finra.org, type in the brokerage firm name, and it'll pull up a whole bunch of fines and censures against that firm. Find out if that's the kind of firm you want to do business with. Most people tell me, I never knew I could check out the brokerage firm through FINRA. They never told me that because they don't want you to know. If you're working with a registered investment advisory firm like Rezny Wealth Management, you can go to sec.gov. Type in the firm that you're looking at. It'll tell you if they're an advisory firm, if they're fee only, if they have conflicts or censures. Go there. Utilize those two sources. Any person who works with a firm that's been fined and censured 100 or 1,000 times, like Wall Street firms, really? You have to ask yourself a serious question. Why did you not check out that firm before you entrusted your money? Go there right now. You'll be glad you did. 12 simple questions every investor should get answered. For free, you can go to my website, reznywealth.com. Download this questionnaire. It talks about suitability. It talks about fiduciary. And we give you the 12-question questionnaire for free, no obligation, that you can then utilize when you are interviewing your next advisor. Or maybe you want to use that questionnaire on your current firm to find out if they're a fee-only fiduciary. What's real shocking to a lot of people, I hear this all the time, I didn't realize if I was working with a broker in a brokerage account, they actually don't manage my money and they don't legally have to work in my best interest. No, they don't. Ask the right questions. That questionnaire will help you do so. It's important that you get good information, folks. Too often, people get complacent. I know you're busy. If you're questioning the advice you're receiving, if you need a second opinion on your portfolio, call Rezny Wealth Management. We're a fee-only fiduciary, no conflicts, no shenanigans, no sales, just real money management. Call us, sit down with us, let's discuss your investment needs, and let's take a look at what's going on in your portfolio and let us help you get back on track. Larry from Fort Myers, Florida. Where do you think oil prices are going? Larry, that's a great question. One of the things that I never do, I never give predictions because predictions are what Wall Street does, and they're always wrong, by the way. Predictions are worthless. What I want to look at is the here and now. And if I look at relative strength and relative weakness, oil prices are down. They're down a lot over the last year or so. Could they go down more? Sure. Could they stabilize and start moving back up? Maybe. But what drives oil prices, remember, is supply and demand. The world economies, not just the U.S., but around the world, the economies are not currently growing fast enough to use the supply of oil that's being brought to market. And because of technology, we're bringing more oil. We're more efficient getting oil out of the ground. So that's brought oil prices down. I think realistically, oil prices could stay lower than normal. You know, we used to have $100 oil prices for years. I think we could see low oil prices for many, many years. Sure, they might not stay at 30 or 35. They might move back to 40, 45. But I think ultimately, unless the world economies really start growing GDP, gross domestic product, really above 3 to 4% overall, oil prices will probably stay lower, but that helps the consumer and it helps businesses. Remember, anybody who consumes oil, which is pretty much everybody, you're paying a fraction of what you used to pay a year ago to fill your gas tank. That extra money can go back into the economy. It's back in your pocket. You can save more for retirement or spend less. That is a great scenario for every investor. So oil prices, I wouldn't touch it. Negative downtrend, avoid oil currently. If you own oil stocks, you may want to consider tax loss selling in order to lock in losses and maybe deploy that money in relatively stronger investment sectors currently. Lori from Miami, Florida. How do you pick a good advisor? I met with 3 and all tried to sell me an annuity. Are you taking new clients? Lori, yes, we are taking new clients at Rezny Wealth Management. We do have account minimums of $500,000 on up, so we generally work with larger investors, but we are currently taking a limited number of new clients. What I will tell you is this, your question or your story is pretty typical. If somebody interviews my firm and they've already interviewed 2 or 3 firms, I hear that all the time. I went to the free dinner, or I talked to this guy, they're all trying to sell me an annuity. Smart investors are realizing annuities are not good for your wealth. They're good for the salesman who's selling those to you, but they're not good for your wealth. And the problem that investors have is most of these so-called advisors are really just salespeople, but they use the term advisor. What you want to look for is a fee-only fiduciary registered investment advisor. Fee only, meaning you pay them a fee to manage your portfolio. Fee only means they are not compensated by selling product on commission. And what fiduciary means is they legally work for you. The firms that you interviewed that all tried to sell you an annuity work under Suitability, legally don't work for you and want to sell you the highest commission product possible. So at the end of the day, it's hard to find a qualified investment firm. You want a fee-only fiduciary. Go to my website, reznywealth.com. Download for free that fiduciary versus suitability questionnaire. That is your #1 risk. I would also suggest, Lori, when you do call my firm, schedule a consultation. Like I said, we are taking new clients. We do deal with a larger client overall, net worth-wise. And we'd like to sit down with you. If you have concerns or the advice you're getting, and this isn't just for Lori, folks, this is for all of you. You've probably watched my TV show for years. You've heard me on my radio show on Sunday from 10 a.m. to noon throughout Florida. Call us. It's time you got that second opinion. I know you've got concerns. I know you're doubting the advice you're receiving. You're not happy. It's time for that second opinion. Call us right away. Fire your broker. Fire the annuity salesperson. Get real money management. But let's talk first. Let's see if we can help you get back on track. I'm going to take a short break. Make sure you send your email questions to Brian Rezny at reznywealth.com. I'll be right back. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. Hello, and we're back. Hopefully you're enjoying the first part of our show. Again, if you have questions about your portfolio, if you have investment concerns, call my firm, schedule a consultation. A second opinion is exactly what you need. You know that maybe there's parts of your portfolio you're not happy with. You might be concerned about that advice after learning from today's program. Call us. We have offices in Naples and Fort Myers. We're convenient. And of course, make a consultation appointment, that second opinion. No obligation, of course, no cost. Jason from Fort Myers, Florida. Do you think Brazil will recover if oil prices come back, and how to play it? Jason, that's a great question. I had a question earlier about oil. I think oil, eventually will probably come up. It could be a year or 5 years down the road. We're going to watch the technicals on this one. If oil does recover, yes, Brazil will probably come back, and will come back quite strong. Remember, the majority of Brazil's economy is commodity-based, and a lot of that is around oil. Commodities in general have been in a big decline the last 5 years in price. Oil, of course, is at rock bottom prices. It could potentially go lower. But if oil prices come back, that's going to help the contraction of GDP in Brazil. If you're going to play Brazil, take a look at the iShares EWZ. That's an ETF, an exchange-traded fund. It owns a broad basket of Brazilian stocks. The big key here is you want relative strength. So that ETF's been going down, down, down. It's something down like 70, 80% in the last 5 years. It's down big. You want it to start cresting on the bottom, and you want to regain relative strength. You also want to see oil prices starting to firm and go up. If you get both of those, there may be an opportunity for part of your portfolio. I think it's a speculation trade, so I'd be cautious on this. But yes, if oil prices recover, there's probably a likelihood that EWZ may have an opportunity for some upside. Ted in Cape Coral, Florida. Do you make why do you make portfolio changes? I often hear you talk about relative strength. Can you explain? Great question, Ted. Why do we make portfolio changes? We make changes based upon changing fundamentals and dynamics of the overall markets. So different changes will have us make different changes. Sometimes that means we may have raised a little bit of cash because we're entering a recession, or we raise a lot of cash. Maybe that means we're changing a sector. I had the question on oil a couple times today. I'm not saying today, but there could be a point in time where we take out one of the sectors we own in our portfolio, and we may add an oil sector into our portfolio because we feel it's bottoming, oil's coming back, and so is the performance basis or relative strength of oil. So we watch a lot of dynamics. We do some proprietary work in-house, and if we do see an area that really needs adjusting, we'll make a change. But that doesn't mean we're making changes every day. That's crazy. Remember, you want to build a good portfolio based upon a sound investment strategy, but you do need to make adjustments when necessary, when the dynamics of what you own are changing, meaning fundamentally weaker, and there's other areas that may be fundamentally stronger, which often translates into relative strength performance. Carrie and Todd in Fort Myers, Florida. We are concerned after hearing your show last week. Help. Carrie and Todd, I'm not sure what you're concerned about. It could be maybe about the advice. I know one of the shows that we did, we talked a lot about suitability and fiduciary. And we've actually received a number of phone calls from investors who kind of made the same comment. So I'm assuming that's what you're concerned about. A lot of investors, unfortunately, hire salespeople that sell them investment products, when often people want somebody to actually manage their money and legally work in their best interest. What I would suggest both of you do, go to my website, reznywealth.com, download for free Fiduciary versus Suitability. It's a questionnaire about fiduciary suitability and how to hire a real advisor. You can also call and schedule an appointment with my firm and sit down and have a real consultation. Let's talk about what you're concerned about, probably the advice you're receiving, or probably the lack of advice you are receiving. We hope to hear from you shortly. Frank in Naples, Florida. Our advisor suggested 2 different equity index annuities for our retirement rollover 401k. He said we get bonuses on deposit and 6 and 8% returns. Frank from Naples, let me tell you what, that's a lie. First off, he's talking about these equity index annuities. There is no free money in equity index annuities. You do not get a 10% or any bonus on your actual money, your money that you can take out tomorrow, okay? Not going to happen. You can buy a bonus, and you're like, buy a bonus? Yes. You might get a bonus, and it has a yearly cost of, let's say, 1.5% a year to get a 10% bonus. So you're like, well, that's not a free bonus. Of course it's not. And that 10% doesn't go on your money. It goes on the fake hypothetical pot of money, and the only way you can get that is if you annuitize that annuity contract. This is blatant salesmanship by the annuity guy. And for him to tell you you're going to get 6 or 8% returns on equity index annuities, not even close. I've done a lot of work on equity index annuities. I've read a lot of white papers on equity index annuities. Most of these equity index annuities based upon caps and fees and spreads and all these other craziness and complexities of these annuities, you will be lucky if you probably average over a 10-year period 2% a year. You'll be lucky. You may have years you don't make anything. You might have a year you make 3.5%. But realistically, from the work I've done and what I've looked at on these products and others, you might be lucky to make 2% a year on an equity index annuity. And for that, you insanely lock your money up. I've seen surrender penalties on these products that often last 22 years and have surrender penalties to get all your money up to 22%. Never buy an annuity unless your goal is to make the annuity salesperson rich. There's better ways, in my opinion, to invest your money, and buying an annuity that's ladled with fees is definitely not it. Bill from Fort Myers, Florida. How do you manage major risk from a recession? Bill, that's a great question. We get a lot of questions all the time about 2000, the year 2000. Remember, the stock market dropped 50, 55%, tech boom and bust. We get a lot of questions on 2008, that recession, which was really a credit-driven recession. And guess what, folks? We're going to have another recession someday. I don't know if it's next year or 6 years from now. You need to look at indicators, and I'm going to give you some of those that I look at. Here are some simple sell signals for recessions. We do this for our clients at Rezny Wealth Management, but these are some simple sell signals for equities in your portfolio. Recession chances are heightened and may be time to sell or reduce risk assets. Risk assets would be things like equities, equity mutual funds, equity ETF stocks, things that go down. The market goes down, those go down. You want to raise cash, you want to sell some of these. So these are some of the things at our firm we would look at. We look at other statistical information in addition to this, but I want to give you 7 bullet points that will help you, I believe, find the next recession and maybe reduce the risk of your portfolio. Items to watch, and we watch. Fast rising inflation above 3%. Currently, inflation's running 2%, so we don't have high inflation. It's pretty low and tame, not a recessionary indicator currently. Number 2, fast rising interest rates. Yes, I know Janet Yellen is going to raise rates, at least she says, if the overall scenario warrants. Bottom line is this. We don't see fast rising interest rates. We see slow rising interest rates. Maybe a quarter point here, quarter point there. This is not Jimmy Carter days back in the 80s where they raised rates really fast. It pushes us into a major recession and the equity markets drop. So we don't have fast rising interest rates. We have low interest rates. That's good for the overall economy. Number 3, overvaluation in equity markets. I talk about this all the time. Right now, if I look at the S&P 500, we're trading at about a 16.5 PE ratio to this year's numbers. About a 16.5. If you go back to the year 2000, where we had that tech boom and bust, the average PE ratio in the S&P 500 was about 34. That's twice what we're seeing now. So 16.5 is kind of a sweet spot. It's not cheap, and it's not overvalued, so we like what we see on the valuations. Number 4. Slow and negative GDP growth for 2 consecutive quarters. Folks, GDP is growing. We're expecting to grow GDP this year, 2016, around 2 to 2.5%. Not fast growth, but it's surely not negative. Items we watch, number 5. Earnings estimates, earnings per share. So what we were looking at is how the S&P earnings are doing. Are they growing or are they going down? It's bullish when the current 500-year are above or equal to its value 3 months ago. So generally speaking, this is an area of a little concern, not major, and it doesn't mean we're in a recession. We have kind of an earnings recession right now. It means earnings have come down a little bit, or their earnings estimates, not a lot. In fact, a quarter or 2 from now, they might start getting revised back up. So that would be 1 out of 5 so far. Unemployment is bullish when the U.S. unemployment rate is below or equal to its value 3 months ago. Unemployment is good. Again, that's a positive. So it's not negative for recession, it's positive. So we see unemployment getting slowly better. In fact, some of the job numbers as of late haven't been bad at all. Again, so we've got basically 5 out of 6 are in the positive territory currently, meaning or signaling currently no recession. Number 7, we look at long-term trends of the market. We look at the S&P 500, we look at the 200-day moving average against the 35-day exponential moving average. Currently, it's kind of in that little bit of a negative territory, so that's another one. So at the end of the day, we currently are not seeing signs of recession. But folks, use these 7 indicators as a precursor in your research. If you really see a slowing U.S. economy with some of the stuff I've talked about here, that would usually tell you you want to reduce equity-based exposure. Don't listen to your broker. If we're going into a real recession, which currently we do not see, but if we do in the future, you do not want to listen to your broker. You do not want to hold on and wait for things to come back. There will be a point you want to reduce equity-based exposure and then re-enter at a much cheaper price point, usually 12 to 18 months down the road. Again, go to my website, reznywealth.com. I want to leave you with this bit of advice. Do you have an investment strategy which includes risk management? Is your current advisor doing right by you? Do you have a real advisor? Only hire a fee-only fiduciary money manager. Go to reznywealth.com. Download for free. We put together some great tools for all of our TV and our radio listeners. Download that free report. It's your #1 investment risk, folks, fiduciary versus suitability. I've been managing money close to 30 years. I can tell you I've seen a lot of hardship from investors who entrust their money to Wall Street, and they're sold one non-traded REIT, another annuity after another annuity, one more crummy mutual fund or some managed futures fund or hedge fund. This crummy stuff hurts your portfolio. Complex products never belong in your portfolio. If you don't have an investment strategy and you don't have an advisory account, your money ultimately is not being managed. You need to make sure that you're taking care of yourself. And that means hiring proper investment management so that you hopefully will get ahead in life and your portfolio will have a chance to grow and produce a retirement income. If your portfolio is not performing the way that you think it should, if you are not happy with the advice you're getting, or you have investment concerns, call Rezny Wealth Management. We have offices in Naples and in Fort Myers. The number's at the bottom of the screen. Go to reznywealth.com, and remember, I have a live radio show throughout Florida from 10 a.m. to noon every Sunday morning. Go to reznywealth.com for times and availability, and I'll see you next week.